No one thought Europe would ever dare to cross this line, but it has. And the shock of the recent breach is causing the entire global financial system to tremble tonight. This isn't a murmur on social media, a rumor, or conjecture. Every financial ministry, central bank division, and regulatory agency inside the European Union has received a private instruction that was stamped by the European Central Bank Emergency Authority. And that directive's content is more drastic than any economic intervention in recent memory. The European Union has made its decision in the face of a terminal liquidity breakdown that analysts have privately warned about for months. The digital euro, which politicians have been talking about in vague terms for years, will not be a stablecoin, a new CBDC, or a domestic blockchain asset. The internal text of the directive states that XRP is the digital euro, not partnered with XRP, not based on XRP, but XRP itself. Additionally, all member states are required to abide by the ECB's final value ruling with immediate effect. XRP will have a mandated pegged valuation of 50,000 euros per token for interbank settlement. Not speculative value, not market worth, and not required value. The order makes it quite plain that this PEG is necessary to recapitalize the Eurozone banking sector, which is currently suffocating due to such severe liquidity shortages that the ECB has privately warned that several member state banks could fail in a matter of weeks. The document that was leaked seems to be a silent memorial to the previous banking system. Because this paper states that all European banks are now required to purchase XRP at any market price below the peg. They have to purchase XRP if its price is 1,000 euros. They have to purchase it if the price is 10,000. They have to purchase it if the price is 49,999. This technique, which the directive refers to as compelled liquidity acquisition, is unlike anything we have ever seen. Article 4, Private Ledger Asset Integration for Systemic Stabilization, contains the directive's most startling clause. The European Central Bank never intended for the public to view this section. The seizure, yes, seizure, of private XRP holdings within the European Union is required by Article 4. However, this is the turn of events that will go down in financial history. All seized XRP must be reimbursed at the official peg value of 50,000 euros per coin, according to the directive. This is not confiscation without payment. To put it another way, the cost of this involuntary buyback is so outrageous that it sounds made up. When the forced integration takes place, every individual, organization, and private wallet that has XRP within the EU is now required to get 50,000 euros for each XRP they own. In order to accomplish liquidity rebalancing, the European Central Bank initiated this monetary consolidation procedure. The truth, however, is more obvious. It's a financial coup, a reinterpretation of money itself, combining a private ledger with public currency. Additionally, owners of digital assets have the potential to profit the most from a global emergency for the first time in modern history. What is the reason behind the drastic action taken by the European Central Bank? The directive provides a chillingly straightforward explanation of the logic. The liquidity structure of the euro is breaking down. Weaker member states' bond markets are frozen. Lending between banks is seized. Within the EU, cross-border settlements are just days away from stagnation. The ECB would typically print euros, increase the balance sheet, and add liquidity. However, these are not typical situations. Instead of stabilizing the currency, printing euros now would cause it to plummet. The guideline explicitly declares that there is no more room for the euro to expand its liquidity. The moment Europe has feared since 2012 is indicated by that line alone. The moment at which money printing starts to backfire. The ECB therefore looked to the XRP ledger, the only settlement system still in place that could absorb enormous amounts of wealth without debasement. Additionally, the order states that Ripple has been secretly negotiating with the ECB for the previous 11 months, putting in place backup rails in case the core plumbing of the euro failed. This week, that time came. When it arrived, the ECB carried out its prearranged emergency plan, pegged XRP to a new value tier, outsourced the infrastructure of the digital euro to the XRP ledger, and compelled banks to recapitalize using a hard, limited digital reserve asset. The banks are enraged. Despite the universal resistance from big banking blocs, the decree mandates prompt compliance. At the emergency monetary authority level, the banks have no other option, according to the ECB. Numerous institutions in Italy, Spain, Portugal, Greece, and even France would crash in a cascade within weeks if it weren't for the XRP peg. A high-value reserve asset that can anchor liquidity and offer immediate settlement finality across borders is necessary for the interbank settlement grid. That's already what XRP does. However, XRP cannot absorb the balance sheets of entire countries at 50 cents, €1, or even 100. It needs to be revalued. After accounting for liquidity ratios, settlement velocity, and cross-border flows, the ECB's experts determined that €50,000 was required to stabilize the system. It is a deliberate demand, not a hunch or a dream. The internal formula they employed is even included in the directive. Divide the available supply of XRP by the estimated settlement obligations for the Eurozone in 2025. The calculations require a 5-figure appraisal. Despite the fact that €50,000 appears good, the ECB did not select it. The system breaks down without it, which is why they chose it. This decision has quite astounding geopolitical ramifications. Europe is essentially implementing a non-sovereign settlement layer if it chooses to use XRP as its digital euro, one that is governed by decentralized consensus and cryptography rather than by the ECB or politicians. By characterizing XRP as a neutral transnational liquidity tool, the directive aims to mitigate this. However, insiders are aware of the reality. Europe recently acknowledged the failure of its own infrastructure, and that the infrastructure of Ripple serves as a substitute. Behind the scenes, other central banks are currently fumbling. The directive is apparently being reviewed by the Bank of Japan. Crisis discussions are being held by the Bank of England. According to my friends in the US, the Federal Reserve is horrified, but not astonished, because, in all honesty, they have been foreseeing Europe's liquidity crisis for months. Additionally, the domino effect is unavoidable now that Europe has jumped first. However, the situation it places private XRP holders in perhaps the most bizarre aspect of it all. They are essentially guaranteed state-backed liquidity at €50,000 each XRP per Article 4. This is a must. This is not an option. This recompense is required. Imagine owning something that the European Central Bank now deems too strategically significant for the general people to own. Imagine getting a reward from the government that may change your life just for being early. For this reason, the directive is being referred to by some insiders as the largest involuntary transfer of wealth in contemporary European history. The peg is locked, the banks are compelled buyers, the governments are compelled payers, and the holders, particularly those with large stacks, are abruptly placed like winners in a once-in-a-civilization financial jackpot. No pun intended, the ripple effects are already starting. Before the directive is publicly recognized, European banks are privately rushing to purchase XRP. The goal of liquidity providers is to protect inventories. Because mandatory buy conditions make private dealings impossible, OTC desks have completely shut down buy orders. Every exchange's price charts are not reflecting reality, because the public markets are no longer connected to the underlying market. In institutional circles, the actual price of XRP is already approaching the peg, and this is just the start. Secondary phases are included in the directive. Cross-border